So a very good afternoon and welcome to our class today. So as agreed in the past, today we start our first topic on taxation. So I want to introduce taxation. So taxation, and in today's class, we begin with basic concepts. We'll begin with basic concepts as we proceed to other topics. So here we go. Let's begin by defining the term tax. So definition. What is a tax? So we'll first define what a tax is, and then we can proceed. So in our basic concepts, I'll briefly define taxation, and then we look at other key concepts in tax before we just 1 minute. Okay. So this is like introduction. So how do you define taxation? So please just put down this and say a tax is a compulsory contribution. The compulsory contribution by citizens to the government to enable it to meet public expenditure for a common cause So in its basic form, you can define tax in those words. And I want to explain a few things there. So in its most basic form, any tax is a compulsory contribution. And it's made by citizens to the government to enable it to meet its public expenditure for a common cause. First of all, we prefer to call a tax a contribution rather than a payment, and there's a reason for that. So any payment you make, you want something in return, something in equivalent in return, and that in Latin, there's a phrase called quid pro quo. So that phrase in Latin means you must give me something proportionate in return to what I've paid. Now, tax is not like that. As we continue in our discussions of some of these concepts, you'll find that we don't pay the same tax. There are those who are in a position to pay more, but it doesn't mean they'll get more in terms of public services. So you cannot get an equivalent of what you pay. Indeed, there are many that might get very little out of public expenditure, because public expenditure is expected in public spaces like public hospitals, public schools, you know, but at least all of us enjoy infrastructure, you know. Infrastructure is roads, bridges, railways, you know, all security, you know, public security and so on. That's all part of public expenditure. So we prefer to call tax a contribution and not a payment for that reason. And then we quickly add the word compulsory. Why? Because if you don't pay tax, then there are consequences, there are penalties, and so on. So if you don't pay housing levy, and it has been passed in law, there are consequences to that. That's why the government thought they should make it a tax, so that it's not voluntary, it's a must. And by entrenching it in law, you give opportunity to employers to deduct it from employees' salaries because it's legal. That's why there's a struggle, because the court find it unconstitutional. So let's hope the government in its effort will put in place frameworks that will convince the court that now it's no longer discriminatory, because it was argued in court it targets only those who are employed, so it's discriminatory. A tax should, you know, a tax should be, the burden of tax should be equitably borne by all citizens. So the court was convinced that this one is discriminatory. So any other tax, not necessarily housing levy, is compulsory. So it's a contribution that is compulsory, and you only pay to the government, not any other person. And there's a reason for it. It's for public expenditure. And this public expenditure is for common cause. Common cause means the expenditure is in the public interest. So you don't, if a bridge is being constructed somewhere in Nyali, you may not live in Nyali, but it's in the interest of the country, the interest of Kenya. So if we are constructing, we are extending part of the port facilities in Mombasa, then it's in the public interest, it's for a common cause. Then you might want to add this, because it qualifies exactly what a tax is. You might also want to add, there is no personal benefit. There is no personal benefit. There's no personal benefit. Or there's no direct benefit. Let me call it that. There is no direct benefit. For payment of tax. So generally, that's what you can say about a tax. Probably, I should also put some 3 key distinguishing characteristics to help you know the difference between a tax and any other payment to the government. So I'll also want to look very quickly at only 3 characteristics. Characteristics of tax. What are the key distinguishing characteristics of a tax? A, it is payable. It is payable only if there is income. So without income, there is no tax. There must be income. So before you get a job, you could have a PIN number, but nobody would really, even if you file returns, it would be nil returns. It will not be based on any deductions of income tax under the pay system. So there must be an income. And B, it is payable only if there is an income. And B, there is no direct reward. There is no direct reward or benefit. So KRA has categorized corporates into large taxpayers, middle taxpayers, and even small taxpayers for the convenience of collecting revenue. And this has brought about some administrative efficiency. So large taxpayers are some of the top companies, insurance companies, banks, companies in shall I say, in IT or provision of telecommunication services like Airtel, Safaricom. All those are in the categories of large taxpayers. So all KRA can give is a certificate and maybe publicize and say Safaricom is a good taxpayer, but there is no direct benefit. There is no direct reward or benefit. So you cannot get a check for your good performance as a good taxpayer. So Safaricom has had a very good track record with payment of tax. Probably that is a plus in marketing themselves as being a responsible citizen, very responsible citizen, because they pay their taxes to the community and so on. So the characteristic here is you could be a good taxpayer and you take it as a responsibility as a patriotic citizen, but you'll benefit from your taxes, but not directly. Unlike if you go to a supermarket and you want to buy a loaf of bread, the benefit is direct. You pay money, you get bread directly. For taxation, there's no direct benefit, even though we benefit as a country. And then thirdly, there are penalties. There are penalties for non-compliance. There are penalties for non-compliance. That's why our Kenya Kwanza government tried very hard to include, even though they didn't do a good job, that's why they're having problems. They wanted housing levy be included in the law, entrenched in the law with the framework and everything. The only problem is they started deductions before that was done. They want it to reach a point where it's compulsory, because taxes are compulsory, so you don't have choices. Remember, the same projects were being done by Jubilee government, but are at an entirely different policy. They did not seek to tax the citizenry, construct affordable housing. So most projects which are actually being completed now are completed by the Jubilee government, but without collecting anything from the citizens, while Kenya Kwanza wanted to do it differently. So that serves as a good introduction to what taxation is. You can, using this, you'll be able to distinguish other things that are not taxed, like a license. It's still a payment to the government. You can pay driving license through e-citizen or renewal. But for driving license, you cannot call it a tax. Why? There's a direct benefit. Once you get that license, you officially allowed to operate within the Kenyan boundaries. You can drive officially without harassment because of the official sanction of the government. So tax is different from license, and is different also from payments. There are payments like for railway services. This year, railway services, SGR, have increased tremendously. I just saw a discussion on social media of how people have made a choice and they preferred now to use probably buses from the coast because it's an open market. They find SGR suddenly to be more expensive. It's like they doubled the prices beginning this year. Now they're having less customers. Now that's an example of a payment. If you get an SGR ticket, you expect something in return, and that's a service, which means you expect to be transported from Nairobi to Mombasa or Mombasa to Nairobi. By the way, the journey is very, very nice and very, very different from what railway transport used to be. Okay, this is not the best because it's not an electric train, but it's very good. For those of us who are traveling with the old trains, I find these ones, a big improvement, quite a big improvement. If you've never not yet used the SGR, probably should plan to try it and see what happens. I don't know whether there's any question on that introduction, because I want to move on to the next thing, and that is purposes of taxation. What are the purposes? Purposes of taxation. So taxation is a very old subject. It goes back in the Bible, in China. Very old civilizations have used taxation for different reasons, and we'll be looking at some of them. Mostly, taxation is used by the government to support its programs. Now, those programs include, in some cases, war. King Henry of France and also kings in England would extract tax, including Napoleon Bonaparte. If you did some history, the guys I'm talking about, waged a lot of war in Europe to expand territory, because by fighting other communities and expanding territory, you could get gold, you could get more land, and so on. But war was a very expensive affair to support, and so on. In the Bible, King Solomon is known to be a great king, but apart from his greatness, he is known to be one who married very many wives. I don't know whether there were 300, I think, were wives, and then he had concubines. Now, all these concubines are to be supported from tax. So he overtaxed his people. So upon his death, people rebelled, and Israel was divided. You can read that in the book of Kings. I can't remember the chapter. But the country was divided because people told the son, I think Jeroboam, they asked him questions. Are you going to overburden us like your father? Because Israelites are to pay taxes to maintain all those palaces. And to keep Solomon happy, it was expensive now. Back to this. So what are the purposes of taxation? So usually, the examiner can be even specific and ask you, what is the purpose of excise duty? Even if you don't know the purpose of that specific tax, there's one general purpose for all of them, whether it's capital gains tax, excise duty, corporation tax, VAT, stamp duty, petroleum levy. All those are taxes that operate in this country. But one common thing about them is they all raise revenue for the government. So usually the key purpose always for the government for imposition of taxes is to raise revenue. So number one, you say raising of public revenue. Raising of public revenue, raising of public revenue to meet public expenditure. Raising of public revenue to meet public expenditure. Raising of public revenue to meet public expenditure for a common cause. Yes, in the public interest. Raising of public revenue to meet, raising of public revenue to meet public expenditure for a common cause. Okay, so this will be the same for any tax. The main reason why you levy capital gains tax, stamp duty, petroleum levy, corporation tax, VAT, excise duty, customs duty, any of those, the main reason is to raise revenue for the government. In the year 2023-2024, the government's budget is 3.6 trillion. Out of 3.6 trillion, some of it, the target is to raise from borrowing, but the main source of revenue for the government is taxation. So KRA has been given one of the highest targets this year. KRA is expected to collect, I think, about 2.5 trillion, thereabouts, 2.5 trillion or 2.4 trillion, thereabouts. We don't know if they are going to meet that target or if it's going to be a shortfall. So we're saying the main purpose for any tax One of the key purposes is to raise revenue. And why? In order to meet public expenditure for the common good, for common cause. Number two, the second purpose, protection of the health. Protection of health of citizens, protection of the 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 health of citizens. Then you explain that point and say, high excise duty is imposed, high excise duty. High excise duty is imposed. High excise duty is imposed on the manufacture of goods. High excise duty is imposed on the manufacture of goods considered to be harmful. On the manufacture of goods considered to be harmful to the health of citizens. Considered to be harmful to the health of citizens. Considered to be harmful to the health of citizens. If consumed in large quantities. If consumed in large quantities. If consumed in large quantities, e.g., if consumed in large quantities, e.g. beer. E.g. beer, cigarettes, wines and spirits. Wines and spirits. Okay, so some of these goods we are mentioning are very important for earning revenue for the government. At the same time, we are all aware that people have had their health harmed. Potentially, cigarettes can cause cancer, which is a killer. We thought it was a killer in Europe and in the US, but now it's a killer in Kenya. Such that, why I'm saying that, in most cases, once you contract cancer, the probability most likely is death, though it doesn't have to be a death sentence. There are quite a number of people who've succeeded in overcoming cancer. So cigarette smoking is attributed to causing cancer. Indeed, there was a case in the court, a guy took BAT at the court, and his contention was he's suffering because I think his leg had been amputated, another leg I think was about to be amputated, and he wanted to convince the court that the cause of his problems is because he started smoking cigarettes at a very young age, and there was no warning. I don't know whether you know this, but in today's advertising for cigarettes, like the Health Act, the health regulations require that the consumer must be warned. You must be told that cigarette smoking is harmful to your health, or drinking and driving could be harmful to you. So he argued before the High Court that, look, nobody warned me. I did not benefit from any cautioning, and that's why my leg has been amputated. And he could have succeeded. He almost succeeded until a very malicious lawyer defeated his case. And this was the argument of the lawyer. He said, we accept that cigarette smoking could cause cancer. But now, there is no proof that what caused this cancer is particular cigarette manufactured by BAT. You can't prove that. You cannot say it is Horseman that has caused this disease, or is this brand called Embassy, or another type of brand. So that is what failed him. Otherwise, he would have been paid millions of shillings. The lawyer managed to convince the judges that we agree. Cigarettes can cause cancer, but can the plaintiff persuade us that what has caused him pain is the brand of cigarettes produced by my client and not any other? How do we prove, for example, he did not take all the other types of cigarettes that are there, like Rosa, all the brands that are there. And that's how his case failed. So we are saying, look, these beer and cigarettes are very good revenue earners for the government, right? But at the same time, we can argue, even though they earn revenue, because every year excise duties increased on manufacture of beer and cigarettes. But at the same time, we can argue this is good. Why? Because the prices will go up and most people could stop taking cigarettes or even beer, because of the high taxes and the high prices. But there is a flip side to that. There are Kenyans who the taxes cannot affect because they have sufficient wealth to take wines and spirits to their field. Now, those ones cannot be helped by these taxes, but at least the government will collect revenue. Then there's another sad part to it. Some of the Kenyans are pushed into cheaper brands because if you cannot afford beer, you cannot afford wine, you cannot afford champagne, you cannot afford good brands of cigarettes, then you are pushed to look for, locally and unregulated, illicit brew, which now are killer, they are killer drugs, and so on. So that's how it works. Then number 3, protection of local industries, protection of local industries, protection of local industries, protection of local industries. Then you say high customs duty. High customs duty is imposed on imported goods. High customs duty is imposed on imported goods. High customs duty is imposed on imported goods in order to reduce their demand. In order to reduce their demand, compared to local products. Compared to local products. Okay, so Kenyans have a taste for imported goods. Probably a reason could be quality. Okay, they love what is imported. I don't know whether you know this, but Kenyans, especially the moneyed ones, import even suits from outside the country, a suit to wear. People import even furniture. I'm sure you know that. People import electronics, people import even small things like rum, whiskeys from Scotland and from South Africa, simply because they can afford it. Then the government also wants to collect revenue from that. The revenue collected from these imported brands is called customs duty. So as customs duties increased on those products, those who can afford them can continue taking them. But the key thing is those who are importing them will include them in the prices of these products, making them unaffordable to the majority of Kenyans. Now, that way, our local brands will have a chance, to compete against the imported brands, as long as our local ones are made almost in good quality, just like imported brands. You see, you cannot stop an enterprise from importing, for example, cigar from Havana, Cuba. There are local people who have money who can buy these big cigarettes from Cuba. But then you can tax them, and make that brand expensive. But still, after government has collected tax, there are Kenyans who can still afford. You say, fine, it's market forces. But that's that would be the most rational way of protecting local industry, because you cannot tell BAT, which is an international company, you cannot tell EABL, which represents shareholders. People have bought shares there. It's an investment. You cannot sell them stock. They'll say it's about willing buyer, willing seller. So a wise thing to do is to levy taxes and use these taxes to, for example, put up hospitals, put drugs in hospitals, treat people, and so on. At the same time, make it beyond reach of the majority of Kenyans, so that you protect their health. Then the fourth purpose is encourage exportation. So taxes can be used to encourage exportation. Encourage exportation. The question is, how can a tax encourage exportation? Now, this policy has been there for decades, for years, and it uses VAT. Value-added tax is one of the taxes in this country. So the tax policy says exports are zero rated. Exports are zero rated. What does that mean? Zero rating is a classification under VAT. So under this classification, you charge VAT but at 0%. So under this classification, if you're an exporter, on the selling price of your flowers, your vegetables, your fruits, whatever you're exporting, you'll add zero tax, meaning these goods will intentionally get to the foreign market at a reasonable price to increase demand, so that foreigners can wish to buy more of the Kenyan products. Now, this is very, very intentional. It is meant to increase our exports. Why would a country want to increase their exports? Because we want to earn foreign currency. Why is foreign currency important? It's very important. For example, in this country, we don't produce crude oil. So crude oil is imported at a very high cost and is paid in foreign currency, dollars. Sometimes they demand for a lot of dollars to pay for crude oil, to pay for other imports like fertilizers, machinery, equipment, a high demand for dollars to pay for our debts, Eurobond and so on. The foreign debts is what is depreciating the shilling, The last time I checked, $1 was equivalent to 163 Kenya shillings. So we call that depreciation of the Kenya shilling. So the only thing that can save our shilling is if we also have a supply of dollars coming into the country. That supply of dollars, to increase the quantity of dollars available, can only come from exports. So to encourage that, make sure the tax policy favors exportation. So it's favorable to exportation because exports are zero rated. You'll charge VAT at 0%. The incentive for that is an exporter will claim all their input taxes. This is how it works. You say VAT payable, or it can be refundable. VAT payable or refundable is simply output tax minus input tax. Output tax is VAT on selling price or on sales. Input tax is VAT on purchases. So the exporter has been allowed officially to charge zero on their sales. So it means what they pay on their purchases as input tax is refundable. Now that refund will reduce the cost of an exporter, and that is meant to encourage. So anybody who wants to save in taxes should consider going into exportation business. You can export crafts, you can export vegetables, avocado, and taxation policy values exports. because exports charge zero tax, meaning every month you make a claim to KRA to refund any taxes you paid on any payments or any purchases, whether audit services, electricity, anywhere where you paid VAT to be refunded. No? So that's another purpose. We say encourage exportation. So number 4, encourage exportation and hence the generation of foreign currency. Encourage exportation and hence the generation of foreign currency. Encourage exportation and hence the generation of foreign currency. Then you say, e.g., exports are zero rated. Exports are zero rated for VAT purposes. Exports are zero rated for VAT purposes. Exports are zero rated for VAT purposes, i.e., VAT paid on purchases, i.e., VAT paid on purchases, used for processing exports. Used for processing exports is refundable. Used for processing exports is refundable. Used for processing exports is refundable. So any questions so far? Any questions so far? Then you look at purpose number 5. So number 5 will be to encourage savings. Encourage savings. This time for retirement. Encourage savings for retirement. So tax policy, again, for decades has tried to motivate employees in their younger days to save for their later years, to save for their retirement. Though this depends on the employee. If he takes up the choices that are offered, they'll reduce his tax burden, they'll reduce his tax liability. At the same time, they go into savings later. So there are 2 ways. The first way, you say A, as a contributor. So as a contributor. What this means, those who are in employment could choose to join a pension scheme, which is recognized by KRA. So it should be a registered pension scheme and start making contributions based on what they can afford. Now, the contributions you make towards savings for your retirement will be allowed as a deduction. What does that mean? It means from your salary and benefits, we'll say less contribution to pension. So the amount you're contributing, the exact amount will reduce your exposure to tax, because it will be deducted first before tax is calculated using the graduated scale. Using the graduated scale rates, but there's a maximum. The maximum deduction you can get for contribution to pension is 20,000 shillings every month, or 240,000 shillings a year. Now, the meaning of that is this. There are Kenyans who can afford to save more for their retirement. And there are those who may not be able to save more. So if you are able to save say 8,000 for your retirement, that is what you get as a deduction. But another Kenyan can save as much as 25,000. For those who can save more than 20,000, you cannot get a deduction of 25,000. You'll get the maximum of 20. So the deduction must not exceed 20,000. So because of this incentive or encouragement, a lot of Kenyans will find themselves savings, making contributions, because it reduces their tax burden. tax burden. It's a way of reducing your tax. So once you join a registered pension scheme, or if your employer has a scheme like that, then your employer himself will make the deduction. But if you're joining a scheme that doesn't belong to your employer, then you have to provide the documents, proof of deduction to your employer, so that he can be deducting the amount you're contributing every month from your salary, and you pay tax on what is left. So this is as a contributor. There's another way. It's called as a pension. As a pensioner means time has come and you've reached 55 or 60. Judges in this country retire at 70. You know? So when you reach retirement age, you are now a pensioner. So as a pensioner, there are two ways you can receive your payment. The first way is called lump sum. For pension received in lump sum, then the first 600,000 shillings. 600,000 shillings received in lump sum will not be taxed. In other words, what will be subject to tax is what is above 600,000. I've had people who've received like 800,000 on retirement as pension. Others have received $1 million. So if you are in a scheme and it is registered, then from that $1 million you subtract the 600. You'll only pay tax on whatever is above 600, which is 400,000 if you receive lump sum. There's another way you can be paid, and that's periodic. Periodic means you can be paid, or you can receive monthly payments. If it's monthly payments, then up to 25,000 received per month is exempted from tax. 25,000 a month is like 300,000 per year, and so on. So encouragement, this is number 5. Encourage. My spelling here is not correct. I need to add an N. Encourage. Encourage savings for retirement. Encourage savings for retirement. Then you put A as a contributor. As a contributor, then you say any contributions to a registered pension scheme. Any contributions to a registered pension scheme. Any contributions to a registered pension scheme is allowable deduction. Any contributions to a registered pension scheme is allowable deduction. Is allowable deduction from income. Is allowable deduction from income up to a maximum of 20,000 shillings per month. Up to a maximum of 20,000 shillings per month. Up to a maximum of 20,000 shillings per month. In brackets, 240,000 shillings per annum. Those are allowable deductions. Then B. So B, you call it on retirement. As a pensioner or on retirement. On retirement. On retirement, B on retirement, then you say on retirement, where, sorry, if pension is received in lump sum, if pension is received in lump sum payment, if pension is received in lump sum payment, the first 600,000 shillings, the first 600,000 shillings is exempted from taxation. The first 600,000 shillings is exempted from taxation. The first 600,000 shillings is exempted from taxation. The next point you say, in case pension is received in periodic, in case pension is received in periodic amounts, in case pension is received in periodic amounts, the first 25,000 shillings, the first 25,000 shillings per month, the first 25,000 shillings per month, in brackets 300,000 shillings per annum, 300,000 shillings per annum is exempted from taxation, is exempted from taxation. So that is how tax policy is used to motivate savings for retirement. So the first policy gives you a deduction, which gives you a tax benefit because you reduce your tax. You'd have been taxed on your whole salary, but now they are deducting what you're contributing to pension first. Then they tax whatever is left. So you have tax savings in the first case. And in the second case, you'll have exemptions, exempt limits. If you had contributed to a scheme that was registered, then you'll get exempt limits depending on whether you receive your pension in lump sum or in periodic amounts. So that is purpose number 5. So tax policy has been used in this country to motivate, to encourage citizens not to forget about their old age. You know, you want to be prepared for your old age because it's coming, and you don't want to be a burden to anybody or to your children. You know? I know in our African setting, we always look forward to being supported by the children, but I think it would be better if a citizen had a plan, you know, so that way you're not, you're okay. I mean, your children can start life not struggling with having to take care of their parents, and at the same time, you're comfortable. In retirement, you can take care of your medical bills, your upkeep, and so on. So that was purpose number 5. Then your purpose number 6, encouragement or encourage citizens to acquire residential property. Encourage citizens to acquire residential property. So again, this policy has been there for decades, if not ages. So it's meant to encourage citizens to acquire homes. Just like affordable housing project is meant to encourage citizens to acquire homes, this tax policy is meant for that. So there are 2 ways. The first way is there are savings you can make. Savings to register. Savings to register home ownership. Savings plan. So we call that RHOSP. So if you approach a financial institution like a bank or Housing Finance Corporation of Kenya that run this scheme, and you want to join and contribute bit by bit, and the purpose is to enable you acquire property after 10 years, or if whatever you have contributed may not be sufficient to acquire property right away, you could probably buy land, as most Kenyans do, and then build slowly. you know. So if you join a scheme like that and you're able to bring to your employer the documentation, the amount you're contributing every year, every month, what you're saving to this scheme will be allowed as a deduction. It will be deducted from your salary, so that what is taxable is what remains. But again, this scheme has a maximum. The maximum allowable is 8,000 shillings per month. 8,000 shillings per month is 96,000 shillings a year. Now, that's one option. Okay, there's another option, and this is for those who can afford. There's the option of mortgage. Now, a mortgage means you qualify to get a housing loan from a bank. 5 million, 4 million, whatever amount, and that amount is not given to you. It's used to buy property. And the title remains with the bank, and you'll be making payments every month, including interest, you know, until you complete. This is where the problem comes in. The government realized out of research and out of collection of data that a very small percentage of Kenyans can manage to service a mortgage, like 3% of it. So it means 97% are left out. A mortgage can be very expensive. For example, if you succeed in persuading your bank to give you 4 million to buy a 2-bedroom house, for example, you might pay that for the rest of your life, unless your salary is very high, because 4 million will require very large amounts, very large monthly payments, which could run into over 20 years when you're just paying. So this is the reason why policy makers, or the government, if you like, thought probably they could come in and a program of affordable housing, because of this small percentage of Kenyans who can own homes through a mortgage. They use this data to support the idea that the government can come up with a project to enable its citizens to acquire property, because most citizens cannot afford a mortgage. But then you should also be asking yourself, would it be different if you take affordable housing and you're given a 2-bedroom house at 3.5 million? The terms are you give 10% upfront. 10% would be you must raise 350,000 shillings. Then the remaining part would be mortgaged to a bank. In other words, the bank is linking you, sorry, the government is linking you to a bank, so that the bank gives you a loan of the remaining 90%, because you're paying 10%. The 90% you're given is still a mortgage, so you pay the bank. Should you default, again, the same case, just like any other mortgage, the house goes. If you succeed in payment, you could pay that for the rest of your life. But for those who can afford, it's a good opportunity. If you can approach a bank to get a mortgage, or if you can go for affordable housing, I think the objective is good. How do we get people to have houses? The objective. The means might be controversial, but getting a house is always a good thing. So encourage citizens to acquire residential property. So you start with A and say the interest on a mortgage. The interest on a mortgage that is used to purchase. The interest on a mortgage that is used to purchase an owner-occupied property. The interest on a mortgage that is used to purchase an owner-occupied property, is allowable deduction. is allowable deduction up to a maximum, is allowable deduction up to a maximum of 25,000 shillings per month. Up to a maximum of 25,000 shillings per month. Up to a maximum of 25,000 shillings per month, or in brackets, 300,000 shillings per annum. 300,000 shillings per annum. 300,000 shillings per annum. Then we have B. B, the alternative, you say savings to a registered. Savings to a registered home ownership. Savings to a registered home ownership savings plan. Savings to a registered home ownership savings plan, in brackets RHOSP. Savings to a registered home ownership savings plan, in brackets RHOSP, is allowable as a deduction. Is allowable as a deduction. Is allowable as a deduction up to a maximum of 8,000 shillings per month. Up to a maximum of 8,000 shillings per month. Up to a maximum of 8,000 shillings per month. In brackets, 96,000 shillings per annum. 96,000 shillings per annum. 96,000 shillings per annum. Then we go to purpose number 7. Ensure economic stability. So taxes can be used for economic stability. Okay? There are circumstances that could be undesirable for the economy. One of those circumstances is called inflation. So the government carefully measures inflation because it's very, very important. So inflation, in its most basic form, would be simply the change in prices of goods and services from one period to another. So the central bank measures month-on-month inflation. You could also measure annual inflation and so on. So inflation in this country has been varying. I think the latest inflation figures they had, I think, was something like 7.5% or 8%. You know, they call that single digit. In some countries, you could have very serious inflation that even reaches 20%. There was a time in Europe around 1930. It was called economic depression. In that economic depression, inflation hit in Germany 300%. So inflation can reach alarming levels, and it could have very serious impact because it means if you're buying bread last year, the same loaf, 300 grams at 55 shillings, you find that this year you are buying it at 65. You've not changed anything. It's the same loaf, same everything, but you have to pay more. So when you take, if you take a number of commonly consumed commodities by households, like if you take a bunch of them, you take gas, which is commonly used, unga, sugar, bread, you know, things that are used by most common households, and you track the price. It's called Consumer Price Index, CPI. That can directly tell you the rate of inflation, how high the inflation has become, because you are tracking the prices of things that households use very, very commonly. So you can even track the prices month on month. Like in this country, I think the central bank tracks it month on month. Now with that, I'm sure, and with the circumstances in Kenya today, the majority now understand what inflation can mean and how it affects their lives. Now, how can tax policy be used by the National Treasury to try and manage inflation, bring some kind of stability? So when there's inflation, it means there's very high prevailing prices for goods and services. Ideally, the Treasury will increase taxes, especially income taxes, so that people are left with less to spend and reduce pressure on goods to try and correct this, you know? So usually the treatment for inflation is to increase taxes, increase commodity taxes like VAT, income tax, especially income tax, so that people in employment can be left with less to spend and reduce pressure on goods and services and see whether the prices of goods can be managed, you know? But we cannot say tax will be the only policy. Tax has to be supported by another policy, which is managed by the central bank. It's called monetary policy. Monetary policy looks at the money side. Can we try and, you know, reduce the money in circulation by conveniently probably making an offer to banks and to individuals that have money? You're told, look, why don't you invest? We have treasury bills here, and we are offering very high interest rate. So if they succeed, they manage to mop out a lot of money that is circulating, and hopefully the high demand on goods and services reduces. So taxes would be used together. Tax policy has to be supported with monetary policy and other policies also, budgetary policy, to try and take care of things that cause instability, because inflation will cause unemployment. You know, how so? Because inflation will increase the prices of goods and services, then reduce demand. A lot of families, households will not afford these goods. And because of that, it means there'll be no work. Because the producers of goods will say, look, even the stock we made yesterday has not been bought. So they'll tell the workers, why don't you go at home, relax? We will call you when there's work. So inflation can be a terrible thing. So inflation means you can't even work on a budget, because whatever you have budgeted to do, because of inflation, you have to pay more. If you are constructing, for example, and you have budgeted and need this amount of cement, I need this type amount of roofing material, this is what I'll pay contractors. Every day you go to buy cement or other material, you find the prices have gone up. If inflation even affects the cost of borrowing from the banks, you know, the banks have been adjusting their interest rates, and that has put a lot of pressure on people who had loans, because every time they find themselves with increased interest rates. So this causes instability. Taxes or tax policy would only be one among a combination of policies the government can put in place to correct that and bring about stability. Stability means protect jobs, because if high inflation continues, most goods become unaffordable and people have to be retrenched. People have to be retrenched. A better operating environment is where inflation is managed. So the central bank in this country usually targets an inflation rate of single digit, between 2.5%, probably up to 8%, which doesn't reach 10% and so on, so that people can still find commodities affordable and farms can sustain jobs, can continue employing people. So, to ensure economic stability, so we say, during inflation, during inflation, when price levels, during inflation, when price levels of goods and services increase, during inflation, when price levels of goods and services increase, the government can impose higher taxes. The government can impose higher taxes on income. The government can impose higher taxes on income to reduce demand of goods, and stabilize the economy, to reduce the demand of goods and stabilize the economy. In case of depression, in case of economic depression or slowdown, in case of economic depression or slowdown in economic activity, in case of economic depression or slowdown in economic activity, the government can reduce taxes. The government can reduce taxes. The government can reduce taxes to increase demand, and economic activity, to increase demand and economic activity, to increase demand and economic activity. So do we have any questions so far? Any question? We have two more purposes, then we are done with this. I introduced another concept, another different concept. So two more purposes and we're done with this, so that we can discuss an entirely different concept. So the next reason we call it redistribution of income. So number 8, purpose of tax, call it redistribution. Taxes are used for the purpose of income redistribution. So this is a very important role of taxation. Why? Because there is inequality. You know, in Kenya, our society is very unequal. You know, you have 10% of citizens who are very wealthy. You know, they own a lot of wealth and they can afford almost anything. Then you have a big percentage of Kenyans who are in the poor categories, may not even afford food, leave alone taking their kids to school and hospitals. Okay? So tax is a very powerful tool in the hands of the government for redistribution. So there are many ways the government can carry out this redistribution. One of the ways is to use progressive rates of taxation. So the progressive rates of taxation, the marginal rate of tax increases as income increases. The marginal rate of tax increases starting from 10%. It goes to 25%, then 30%, then 32.5%. These are the current rates. Then it goes to 35%. Progressive rates of taxes. It means as incomes increase, they added two more bands of taxation for those who are earning above 800,000 Kenyan shillings. For those who are earning from, I think, 388,000 up to 800, and then those who are earning above 800,000, whatever is above will be taxed at 35%. So this is the progressive rates. It means the marginal rates of taxes increase as income increases. So how does redistribution work? Redistribution works because in progressive rates, we don't pay the same in terms of tax. Those with higher incomes will pay more tax and at higher rates. Then redistribution comes because the government plans spending for the poor out of what is collected. So out of what is collected from mostly rich people who can afford to pay taxes, the government will plan programs for the poor, use the collected revenue, for example, to provide medicines in public hospitals, provide clean water, boreholes, provide roads, that is value, even though the poor are not being given. Okay, in some cases, the government also has social protection. Social protection in this country is being done under a policy, social protection program, under the Ministry of Labor, working together with the National Treasury, where those who are the Ministry of Labor will register the elderly and the vulnerable groups who are aged 70 and above in this country. So those who are aged 70 and above will each receive 2,000 shillings per month. That's social protection. Where is the 2,000 coming from? Tax money. From those who can pay more tax. Tax is collected and services are being given to those who are poor. So it's like you're taking away from the rich and giving the poor. So all those programs by the government, bursaries, social protection for the elderly, is meant to support the poor. Health services or public health services where doctors are paid using public money, education, which is subsidized by the government. All teachers are paid by the government out of tax. So redistribution of income is another purpose for taxation, redistribution of income. You say progressive rates of taxation, progressive rates of taxation are used to ensure, that persons with more income, pay more tax, than those with lower incomes. Persons with more incomes pay more tax than those with lower incomes. In addition, the government utilizes the revenue collected. The government utilizes the revenue collected to provide public goods and services. Which are mostly enjoyed by the poor. To provide public goods and services which are mostly enjoyed by the poor. And you say social protection, e.g. payments made to the elderly. payments made to the elderly, payments made to the elderly are supported by public revenue, are supported by public revenue, are supported by public revenue. So all that is redistribution, you know. Those who are poor will enjoy services they would not have afforded, you know. You go to, if you're in Nairobi, you can attend Nairobi County clinics or hospitals, which are all over Nairobi, you know. Depending on the estate you stay, they're in the estates, you know, Mukuru, Kwanjenga, Kariobangi, you know, in town on Haile Selassie. There's one, they should change the name. It has been always called the Rhodes. There's one just along Haile Selassie. It's called Rhodes. They should change the name to a local hero, some local name we understand, and so on. So these services are made possible out of taxes. Nairobi County collects not taxes, but money from licenses, rates, and provides medication in some of those hospitals and provides public services. The last I checked, I think Nairobi County was going to provide food for all, meals for all primary schools. I don't know whether Sakaja has started the program as yet, but all this is out of collections from people who are able to support social protection services to those who are. So this is redistribution. It's called redistribution. And finally, 9, there could be more, but this is just good enough. Encourage development of industries. In other words, tax policy encourages investment in this country. Just the current Finance Act 2023-2024 reduced corporation tax for foreign companies, non-resident companies, from 37.5% to 30%. This is huge, very huge savings for multinational companies like Shell, like Rubis, you know, Coca-Cola, and they did not ask for it. You know, if you ask me, I'm against this. Why would our government, for example, reduce tax to foreign companies who have not asked for it? They've been operating in this country. They pay tax at 37.5%. They've never complained. Though they say, well, probably we should treat it the same as local companies, you know? You see, this is a big source of revenue for the government, more than targeting those who are in employment. You see, if an employee earning 25,000 is paying housing levy, is paying NSSF, is paying NHIF, is paying all that, then it doesn't make sense to reduce tax for a multinational, a big corporate like Rubis. Okay, so they are so relieved. They've made millions of dollars in savings, and they did not ask for it. And if probably, I think one of the key reasons why they're doing it is to motivate multinationals to come to Kenya to invest. But these ones are already here. You know, Shell has been operating in this country for years. Shell is a British company, you know. Other multinationals have been operating here for years, you know. So, one Another way, there are many, of tax policy encouraging investment in this country is to provide investment allowances. Investment allowances. So what does this policy mean? This policy means if you invest in Kenya, you will be granted a claim which you can charge in your income statement. For example, if you invest in clean energy means you put a solar project, you generate a lot of power, you can claim 50% of the cost of those solar panels you put up, or if you're using wind power, using, what do you call them? They're called, there's an equipment that is blown and it goes round and round, and it generates power. It's called, I remember. So I was working with a project of that wind power. They were getting that equipment. Why can't I remember what it is? And it's not difficult. It's not a big word. They were importing from China. Each one of those was costing like $35,000 US dollars to bring and put up in a windy area. So to encourage that, the government is telling you, you can take up to 50% of the cost of that equipment and charge in your income statement. Meaning that year you will not pay tax. Even the following year you will not pay tax. 50% of $35,000 for one. And in phase one only, I think they got an investor from China who is going to send them, or it's called a windmill. Right? Those are an investor, windmill. There was an investor in Kenya, in China, they are going to work with. Phase one alone, the investor was going to send it to Kenya. They were going to install them around Limuru. They had already tested the wind. They had already signed power purchase agreements with Kenya Power, because in this country, you cannot sell power directly. You sell through Kenya Power. You sell to Kenya, then Kenya Power, then KPLC can sell to the consumer. One windmill was going to cost $35,000 US dollars. And phase one only, I think the Chinese investor was going to give them around, I think it was around 25 or 30 windmills. And then the Kenya government is saying, look, you can claim 50% of that cost. So for each windmill, you are going to claim $17,500 as an expense, meaning their profit was going to be negative. No corporation tax. Even the World Bank keeps asking the Kenya government, why are you doing this? Are you really serious about getting taxes? These policies have been there for decades. If you put up a hospital, and I'm glad many Kenyans are now putting up hospitals, you can claim 50% of the cost of hospital equipment, whether you invest in X-ray equipment, equipment for renal, the ones for dialysis equipment, you know, any of those, you can claim 50% of the cost in the first year. And then you continue on a reducing balance, 25% of the second year, and so on and so on. You start a business, whether it's farming, whether it's generating power, whether it's manufacturing, you have huge investment allowances, you know? And the Kenya government is saying, look, this is meant to encourage investment. Though sometimes we need also to have a conversation in the country and ask, does this bring investment or investors come because of other reasons, you see, you can make a decision to come and put up a hotel in Kenya, like the one who put up this huge hotel. What is it called? In Westlands. Huh? It's a big hotel. I don't think he came because of investment allowances. He had done his feasibility study and he decided that hotel is a good investment. And when Obama came in Kenya, that was the hotel of choice. And many other dignitaries come and sleep with their teams in that hotel. Actually, the US government booked the whole hotel for security reasons when Obama was president. So the question is, this hotel in Tuaji, very big hotel. What's the name of this hotel? Okay. So if you are the owner of that hotel, why he came to Kenya? I don't think he came because of these allowances. But we can state that as one of the purposes of tax policy is to encourage investment. So you can put this, encourage development of industries and say, investment allowances are granted. Investment allowances are granted on any capital expenditure incurred. Investment allowances are granted on any capital expenditure incurred. Investment allowances are granted on any capital expenditure incurred to acquire assets. To acquire assets. To acquire assets in establishing. To acquire assets in establishing an industry. In establishing an industry, e.g., factory buildings, machinery, hospital equipment, etc., are granted investment allowances. Are granted investment allowances at the rate of 50%. At the rate of 50% of the capital expenditure incurred. At the rate of 50% of the capital expenditure incurred during the first year of operation. During the first year of operation. During the first year of operation.
Mwalimu, kindly repeat.
No, saying offhand.
So okay. I'm left at 50%. 50%. At the rate of 50%.
At the rate of 50% of the capital expenditure incurred. At the rate of 50% of the capital expenditure incurred. At the rate of 50% of the capital expenditure incurred to acquire the assets for investment. At the rate of 50% of the capital expenditure incurred to acquire the assets for investment. So it's very interesting, but you should know all these big investments being put up, hotels, hospitals. I disagree. Could be I'm wrong, but I don't think those who decided to come to Kenya and put up this big hotel in Westlands, I remember the name. It's a very key hotel then. Especially people who come from the US, they prefer that hotel. Nini, Upper Westlands, very big one. But there are other bigger hotels. I'm not convinced that the reason they came is because of this allowance. But then once they establish, I'm sure they do their feasibility study, they look around, and they decide to put up some millions and put up a business, then they are told, well, you can claim 50% of your cost. I'm sure it's an icing on the cake. Because they say, oh, what a surprise, I did not know that. Our Kenyan brothers, like you accountants will, what our chanua, by the way, they're supposed to claim 50% of your cost. or if they put up a big hospital, you tell them, by the way, our laws allow you to claim. And the World Bank always questions, not just Kenya, developing countries, because Kenya is a developing country. They question, are you really serious? Why don't you do a research? Why don't you do a survey and find out which businesses came to Kenya because they wanted these allowances? And we shall be doing this as a topic. The topic will be called investment allowances. Okay? So anything, this is granted to everybody, not just foreigners. So even if you go into farming, okay, the cost you incur in the farm